And we begin this hour with breaking news from Ottawa.
We have breaking news for anyone with a mortgage or carrying other kinds of debt.
After raising interest rates 10 times, the Bank of Canada held their key rate at 5% today, in line with what most economists expected.
Is anybody else getting tired of the constant stream of breaking interest rate news? The constant over-communication of what is happening with interest rates is getting exhausting. And not only that, it's become inevitable that every single time the Bank of Canada makes a rate decision, even if they don't move interest rates, it's going to be breaking news, even though the decisions that they make are now almost always predictable.
Yeah, so I think this was broadly expected.
As expected, the Bank of Canada left its key lending rate at 5%. The decision was to do absolutely nothing, and that was what was expected, and no surprise here.
But here's the thing, the overcommunication and the predictability, it's by design. Because over the last 30 years, central banks worldwide have shifted from using interest rates as their primary tool to affect the economy to using communication instead. And yes, of course, they still change interest rates, but more often than not, it is the communication about changing interest rates that is now having the greatest effect on the economy. Yes, that's right. In a modern economy, affecting your behavior today by telling you what they are going to do tomorrow is now the most important tool in the central bank's toolbox. And unfortunately, that's becoming a bit of a problem. But in order to understand the problem fully, we need to understand the history of what's happened in the last 30 years with the Bank of Canada and central banks worldwide, as they've shifted to more open lines of communication.
What we want to do is explain to the public the committee's goals and strategies for achieving them.
The transparency is an integral component of accountability.
And that is because of the realization that open communication is often a far better tool when it comes to monetary policy than actually changing the interest rates themselves, except of course when it's not. And we'll get into that a little bit later on. But prior to the 1990s, it was widely believed that the best way for a central bank to manage an economy was by surprising it with interest rate changes. And it was definitely clear that surprise interest rate changes had bigger effects on the economy, but they were also less reliable. In other words, if the market was expecting these surprise interest rate hikes, making them not much of a surprise at all,
Not surprising.
well, that created a scenario where the actual interest rate changes had very little to no effect. So in the early 1990s, the beliefs with respect to the best way to conduct monetary policy shifted drastically. And this happened worldwide, including with the Federal Reserve in the US, which was led at the time by Alan Greenspan.
We've had so many false moves in this particular period that we ought to be looking and saying, well, maybe something is wrong with the conceptual framework which we're using to understand how these markets are working.
And as they tested more open communication, what they came to realize is that the open communication led to more reliable results. So in other words, telling the people what you were going to do adjusted their behavior in such a way that you were able to more reliably predict the desired result that it would have on the economy. And in Canada, the shift to more open communication started in 1991. This was when inflation targeting became the agreed upon policy of the Bank of Canada. And this created a lot of clarity around what exactly the Bank of Canada's mandate was, to keep inflation within a 2% band, which, by the way, was a completely arbitrary number. And yes, I'm serious here, that number is completely arbitrary. It is literally a number that was thrown out there by a New Zealand politician off the cuff when he was in the middle of an interview. And that politician, pulling 2% out of thin air, essentially created what we know today as the 2% policy band, which is pretty much what all central banks now use. Now, in addition to agreeing on that mandate, in 1994, the Bank of Canada also mandated more open communications with a complete communication overhaul. And they took this one step further in the year 2000 when the fad era began.
Understanding the difference between fads and trends is critical for cultural organizations.
No, not that kind of fad. Fixed announcement dates. These were the precise dates announced every single year when the Bank of Canada would be making its policy decisions. And those fixed announcement dates not only gave greater clarity about when interest rate announcements would happen, but they also included press releases which provided, among other things, forward guidance. And just to be clear here, what forward guidance means is forecasts about what the Bank of Canada expected might happen in the future. Eventually, this led to quarterly monetary policy reports, which provided even more detail and more understanding to the public about exactly what the Bank of Canada was doing. Now, of course, a lot of the time these documents were very complicated.
We're communicating to people first. We have to do it in a way that's complementary to other stakeholders and the experts, if you will.
All of this open communication, they believed, would create greater transparency and make monetary policy more effective, which for the most part it did, except for when it didn't.
If you've got a mortgage, or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time.
And we'll talk more about that in a minute. But before we do, it's important to understand that often greater transparency is a good thing, but sometimes it can become problematic, like during the pandemic. There's a clear consensus that more open and transparent communication leads to better monetary policy. There's also a growing debate about how much transparency is too much transparency. Typically, you can categorize central bank communication into one of four categories. The first is the central bank's assessment of the current economic conditions. And the second is the communication of their actual targets, what they are trying to do. Those first two are highly reliable and very much factual in nature. The third and fourth aren't so much. The third form of communication is the strategies that they are going to use in order to hit the targets. And the fourth is forward-looking statements with respect to the economy, with respect to inflation, and with respect to, yes, what they are going to do with interest rates. And it is those two that create the potential problem with the central bank's communication. Because the discussion around the strategy that the central bank is going to use in order to get inflation to come down, or the expectations that are communicated around what the Bank of Canada thinks is going to happen with respect to inflation and subsequently interest rates, can create confusion or expectations around what is going to happen, and those things may not actually happen. And this is exactly what happened in 2020. When the explicit nature of the statements from Jerome Powell in the US and Tiff Macklem in Canada led the economy to recover much quicker than expected. The assertion that interest rates were going to remain low for a very long time, and in some cases with specific dates attached, led consumers to believe that they had a runway to borrow money that was about to become a lot shorter than what was expected. And to be clear, some people think that it was the lower interest rates that led the economy to come back to full steam so quickly. It wasn't just the low interest rates. It was the added confidence that was the result of clear and precise communication from the central bank governors that led to greater than expected growth and subsequently high inflation. That combined with unexpected events like ships getting stuck in the Suez Canal and China closing its borders for a lot longer than expected, created an even more dire situation. And unfortunately, those very precise predictions about when interest rates would go up were not so precise, just like most other forecasts. And that's the exact reason why forward guidance is becoming such a hot topic when it comes to monetary policy. More specifically, in volatile markets, when it's not even reasonable to expect that central banks' forecasts will be accurate. And this is in contrast to when an economy is stable. Because when an economy is stable, it is very easy for a central bank to say this is probably what's going to happen, because it's probably what's going to happen. But when an economy becomes volatile, like when a pandemic happens, well, then it becomes very hard to say this is what's going to happen with any sort of reliability. And then you end up in a situation where people do silly things based on the expectations that the Bank of Canada has set, like buy insanely expensive houses with mortgages that they will not be able to afford if interest rates go up. And when the inevitable happens, that the central bank can't follow through on the plans that pretty much all Canadians base their buying decisions on, well, that's when you get a really big problem. Because it turns out that not only was that plan unreliable, but it was actually completely unreasonable to follow it and make your buying decisions based on it. The truth is that when it comes to the economy, it is impossible for the Bank of Canada, or for any economist for that matter, to reliably be able to predict what is going to happen in the future. They are economists, not fortune tellers. Their job is to give an indication of what might happen in the future based on the data that they have today, but even the economists don't expect those forecasts to be reliable. because something weird could come along, like a pandemic or a financial crisis or any other number of things that could render those forecasts useless. And one of the hardest things about being a central bank economist is that no matter what you say, and no matter how well you communicate, the public rarely interprets what you are saying as what you are actually saying. Now, this is partially the fault of the modern media, who is constantly trying to grab eyeballs by delivering stories that are exciting. And all of the central bank's disclaimers and disclosures, well, that isn't the exciting part of the story. It never is, so it rarely gets reported on. Statements like, the council is still concerned about risks to the outlook for inflation, particularly the persistence of underlying inflation. Or, governing council wants to see further and sustained easing in core inflation and continues to focus on the balance between demand and supply in the economy, inflation expectations, wage growth, and corporate pricing behavior. Or statements like, the bank remains resolute in its commitment to restoring price stability for Canadians, are often absent from mainstream news reporting. By the way, all three of those lines were lines from our recent Bank of Canada news release, and at least as far as I can find, none of the major news outlets actually included them in any of their articles. In fact, pretty much every news article from the most recent Bank of Canada decision downplayed the idea that there could even be a rate increase in the future, even though the Bank of Canada's statements had the disclosures and had the caveats that would lead a reasonable person to believe that interest rate increases were actually quite possibly still on the table. I mean, just check out these headlines in these articles. Interest rate cuts are coming, but the Bank of Canada won't say when. Bank of Canada signals rates might have peaked. What comes next? Bank of Canada signals interest rate relief is coming, but brace for a wait. Those really don't paint a picture that says the council is still concerned about risks to the outlook for inflation now, do they? So the question then becomes if communication is now very much the more prominent tool when it comes to affecting the economy, how does someone interpret what the Bank of Canada is communicating and use it to make their own financial decisions? Well, the Bank of Canada's communications really come down to what they want the broader market to do. If they want the market to slow down, they're going to forecast higher interest rates. If they want it to speed up, they're going to forecast lower interest rates. And of course, they'll make the statements first and then follow that up with the actual rate changes, but more often than not, they're going to communicate what they're going to do before they do it, because the communication is in fact the tool that has the greatest effect. So when they say we might increase interest rates next month, that's going to cause people in the economy to spend less. And if they're trying to adjust the direction of the economy, the direction in which it is going, they will tend to communicate a shift in tone. So in other words, they'll go from saying interest rates are absolutely going up to, well, maybe they aren't going up as much as we thought, to, well, now we don't see any reason to increase interest rates, to, oh, interest rates are about to go down. But that doesn't necessarily mean that what they say is going to happen is actually what is going to happen, because that relies on the market doing what they expect the market to do, as well as there being no other surprises in the economy that affect their forward guidance.
And if everything goes according to plan.
So focusing on the direction of interest rates, which by the way is the most common question I get, where do you think interest rates are going to go, is actually not the question you should be asking. What you should be trying to understand is what the Bank of Canada wants people to do at every single meeting. Are they trying to get you to spend less? Are they trying to get you to spend more? Are they trying to scare you into spending less? Are they trying to comfort you so you spend significantly more? Or are they saying, oh shit, we went too far, we need to fix this fast? And understand that regardless of what message they're trying to convey, there's a high likelihood that they aren't going to get it right. So when they say interest rates are going to come down 3 times by the end of the year, well, they may not actually come down at all. In fact, there's a high likelihood they could actually go up, especially if something unexpected happens. And that's the problem with the Bank of Canada communicating their forward projections. One slip in communication when things are volatile, and you could end up in a situation where a disaster happens. Like the disaster that is coming with all of the people who are about to renew their mortgages in Canada at a significantly higher interest rate than they expected they would have to. But let me ask you this. What if instead of saying interest rates are going to remain low for a very long time, and here's about when you can expect that they will start to go up, what if the Bank of Canada had simply said interest rates are going to remain low for as long as we need them to be low? And instead of saying you have a 2 to 3 year runway of interest rates remaining the same, they were simply saying that we're just going to do what we're doing until such time as we don't have to do that. Well, would that have had a drastically different impact on what happened in the Canadian economy? And my guess is that it likely would have. If people didn't have a clear vision of how long interest rates were going to remain low for, they probably wouldn't have bought the exceedingly expensive houses that they bought. In fact, I might argue that housing prices would have never got to where they actually got to. Because if the public realized that at the drop of a hat, the Bank of Canada could change its tone and raise interest rates, much like they did, they probably wouldn't have made their buying decisions based on those long-term forecasts. But talking about the Bank of Canada when it comes to making our buying decisions negates the fact that we were responsible for our own buying decisions. As much as the Bank of Canada is responsible for the overall economy, we are each individually responsible for our own personal economies, which means we need to be cautious of not following forecasts that are becoming less about predicting the future and more about changing behavior. Central bank communication in the modern economy is not only a tool to affect the markets, but it is the best tool that central banks have. And therefore, if it is a tool that is being used to change your behavior, that inherently makes it a less reliable tool to forecast the future, which means it's also not the best tool for you to use to make your own financial decisions. Because as we saw in 2020, the future outlook of what was going to happen with interest rates was no more reliable than a magic 8-ball.
Ask again later.
And I can't emphasize this enough. Instead of using these forecasts to justify your emotional buying decisions, what you should instead be doing is setting your own operational targets for your own personal economy. In other words, setting targets for what your monthly mortgage payments, your car payments, and all of your other debts should be, as well as what your income should be going forward, and then doing your best to stay within those boundaries. Oh, and those boundaries should probably include a pretty significant amount of your money going towards savings so that in the event that the forecasters and the central banks get it wrong, and something happens in the economy that causes the central banks to have to lower interest rates substantially because things just got really bad, well, you're in a position to be able to pay your debts, keep a roof over your head, and keep food on the table so that you can survive in any negative economic situation. And having this sort of security will help you be able to do things like buy a home if that's what you want to do. Oh, and by the way, if you do want to buy a home, and you want the step-by-step guide on how to do it and not get screwed by a realtor, make sure you check out this video right here.